This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen. Welcome to the program Dollars and Cents. My name is Joel Garris. During the week, we're at the offices of Nelson Financial Planning. But, of course, today is Sunday, which means we're at the Clear Channel. It's not Clear Channel. It's iHeartMedia stations here in Maitland, Florida, hosting the program Dollars and Cents that's been around for well in excess of 30 years. Started all those many years ago by my father-in-law, Jack Nelson. Continued today by me, yours truly, Joel Garris. Wide range of topics on tap for today's program, as there is each and every week. We'll do a follow-up on the actual experience of somebody who owns perhaps the worst investment product that you can have. In the past, from time to time, we get up on a soapbox and talk about these products that you hear a lot about, the guarantees of not losing money and always getting to participate in the market, and never having to worry about anything. Doesn't quite work out that way. We'll give you some actual numbers on that really highlight what you need to be worrying about when you hear these things that sound too good to be true. Because guess what? That's pretty much what it comes down to. Also got some interesting data on who's opening up new accounts since the start of the year. An interesting increase in which portion of the U.S. population is opening up new accounts these days. What is disturbing is where that money is getting invested. That becomes a little tricky when you hear where that money is going. We also got some the latest on the kiddie tax, the new tax changes for 2018. Also address the kiddie tax. So we'll talk a little bit about that. Many don't quite understand how that works. That basically is if you've got a child and they have income in their name, then investment income in particular, then that can be taxed at your highest marginal rate, almost like if that income was on your tax return. What's interesting about that is that the rules on that sort of changed a little bit and may, in fact, result in a little less of a liability for the kids on any investment income that is purely in their name. So we'll cover that. And then, of course, the other topic that we want to hit on the show is some of the changes. Just recap the slew of changes in Social Security and Medicare for the year 2018. So we'll cover all of that on the program, along with answering your calls, your emails, the calls, the numbers to call in, 407-916-5400, toll free 1-855-545-1025. You can send us a text at 23680. Standard message and data rates apply. or you can do it for free by sending an email to my personal email, and then I can look at it on this computer in a hand, otherwise known as a cell phone. The email is simply my first name, Joel, Joel, at NelsonFinancialPlanning.com. So that's how you can participate in today's action here on the program Dollars and Cents. So where do I begin from there? Let's talk about let's start with the topic of who's opening up new accounts. And I guess this is good because the younger you are, the more you want to be able to save money, right? I mean, the younger you are, if you save money, you've got a greater time horizon, greater period of compounding and growth, and just the earlier you can save, the better off you are, because, of course, it is time in with your investments, not timing. So I think too often we kind of get those a little confused. Anyway, the biggest jump in new account openings as of the last quarter of last year was actually the millennials. So congratulations to the millennials starting to kind of get involved in saving and investing and thinking ahead and putting some money aside. So there was actually, and this is data that comes to us from TD Ameritrade, which is one of the largest, if not the largest, among sort of the online brokerage type platforms, reported a 72% increase in millennials opening up accounts. So that's, you look at that headline and you would say, that's good. That's great. That they starting to realize or engage in trying to save some money. Perhaps they're, now getting in to look at their investment allocations. And one of the disturbing trends that's been for the millennial generation is, those were the kids that sort of grew up right smack in that 2008 timeframe. So for them, that weighs very heavily on their minds in terms of their investment allocation. And certainly, there's been some studies that have drawn conclusions that, in fact, they are probably, as investors, in sort of that stock versus bond balance, they probably are heavier on the bonds and lighter on the stocks than really they should be for someone that's still got 40 years before they retire. So when you look at the statistic, you're like, okay, great. Now they're starting to kind of get re-engaged, and that's good. Until you read the rest of the story, which is that this group, right, that went through 2008, saw it firsthand, and rightfully so, very wary, and have been so. But now it looks like they're starting to re-engage. But what they're re-engaging with is that they are investing their money in cryptocurrencies like Bitcoin and my favorite, and we've talked about it on the program before, cannabis or marijuana or pot investing. That's where they're putting their money. Remember, this group, very skewed in its perspective because of the front row seat, just as they were starting to kind of, get clued into what was going on in the world, it was that the stock market was going down. Now, 9 years later, 10 years later, they're starting to re-engage, and I'll be darned, if what they're re-engaging with is something that is so incredibly speculative. You go from being too conservative to being too aggressive, and the only thing that's going to happen on that is you're going to get whipsawed pretty badly. So I fear that generation of millennials may have a pretty hard sledding when it comes to saving and investing, because it seems like they are missing the most obvious of investing tenets, if you will, right? I mean, be diversified, be balanced, and yet they haven't been, and now when they're looking for more growth, they're going into incredibly highly speculative areas of the market. It's frustrating, but unfortunately, that seems to be the pattern. I guess that's basic human nature, right? We always chase after the thing that is attracting the most amount of headlines, even though in the case of Bitcoin, it's, down like 50+% in the space of 45 days. So if you're a millennial and you're listening to the program, try something more traditional. It'll be okay. Okay. Maybe owning, a portfolio that has names of companies, of things that you use every day, Netflix, Amazon, Microsoft, Disney, Samsung, just throwing it out there. Maybe try that instead of something that is not backed by anything, or something that the federal regulations still prohibit in the case of cannabis and marijuana, right? Anyway, just a thought, something to think about. We'll slide to the break. We get back from the break, we'll continue the conversation on the kitties. We'll talk a little bit about that kitty tax change here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 1025 WFLA.
Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents here on News Radio 1025 WFLA. This segment of the program, we're going to talk a little bit about the kiddie tax, which is basically if you have children under the age of 19, or in fact under the age of 24, if they are a full-time student. Traditionally, if they had any investment income, think dividends, capital gains, or distributions from retirement accounts. Maybe they inherited an IRA or something along those lines. That income is going to be taxed at the parent's rate. So basically it was almost like, even though that income was coming in under the child's Social Security number, that was income directly to them, it was almost like it was your income as the parent. So it would just simply get added into your return, which meant effectively that whatever the highest marginal tax rate that you were in was the marginal tax rate that would apply on that income. That was the old rule, where it basically got mushed into the parent's taxable income based upon the individual tax brackets that apply for a parent. So starting this year, 2018, that actually changes a bit. And now that income isn't going to be taxed based upon the individual rates that apply to that child's parents, but rather it's going to be taxed at the rates that apply to a trust or an estate. And that may sound like, well, what's really the difference? And the difference is that depending upon how much income that is coming in for that child, then you may find out that you actually get a little bit lower tax on that income because of where they fall on the trust and estate tax table. Because remember, when we talk about taxes and income taxes in the tax tables, there's certainly a tax table that exists for individuals, right, when you're doing your individual tax return. And then there's, of course, there's one that exists for corporations when they do their tax return. And then there's also one that exists for trusts and estates. So that trust and estates sort of tax rates and what income it falls at is very different than what would apply to corporations or what would apply to individuals. So, for example, in 2018, for a married couple filing a joint return, they're on their income tax table that would apply to them, the top rate of $37,000 kicks in at about $600,000. Okay. Meanwhile, for a trust or an estate, that top rate of 37% kicks in at $12,500. So you would say, well, wait a minute, that's such a big difference. Trusts and estates, yes, trusts and estates are taxed at a much higher rate, much quicker. So you always want to make sure, okay, one of the reasons why avoiding probate and making sure that you've got beneficiaries on your accounts and all of those kinds of things is so crucial, because there's a very different tax landscape that applies when it's a trust or an estate. Well, now the kiddie tax is in that category, but there may be an opportunity, depending upon how much income and where that falls, to actually have less of a tax bill associated with that kiddie tax. If the parents are in the highest tax bracket at 37% for 2018, and the kid's income is, say, $5,000, well, that's not above the 12.5, right, which is where the 37% would kick in on a trust and estates. At $5,000, that's a lower tax rate. So you see where there could be a little bit of savings on that kiddie tax, or the tax that would apply on investment income that kids that would fall into a kid's name. So an interesting sort of twist, if you will, or shift in the tax code itself, whereby previously the kiddie tax would have been sort of mashed under the individual income tax rates. Now that tax that would apply, and again, this is on investment income, okay, that is earned by a dependent child under the age of 19, or if they're a full-time student under the age of 24. So remember what this is. This is not necessarily their work income or their Chick-fil-A job or any of that. This is a tax that applies on their investment income. The notion behind it is that the IRS doesn't want parents putting accounts in the kids' names in order to simply avoid a tax. You're getting a lower tax rate. So the kiddie tax basically takes that, and in the past has sort of combined it into the individual income tax rates for the parent. Now, for 2018, that has changed. The kids' investment income will be subject to the tax tables that exist for trusts and estates, and a very different parameters and tax rates and where those tax rates kick in at what income exists on that trust and estate side. So bottom line, if you're having to deal with this, understand that the game on that has changed. You're now going to be in a very different on a very different tax table, really, than what you've seen in the past. So just be aware. Obviously, that doesn't apply for 2017 because all these new tax changes are 2018 and beyond. So just be aware of that change as it relates to investment income that kids make. So an interesting little kind of nuance of this new tax law that really kind of shifted where that kiddie tax calculation, how that kiddie tax calculation is in fact made. So interesting little change on that we wanted to kind of alert you to to the extent that it applies to you. So we'll tackle what next? Well, let's tackle what we saw in the office this past week regarding certainly in prior shows we have railed on this pretty extensively. There's a lot of investment products out there today that are complete garbage, and many of them have ads and for that matter, programs on various radio stations here in Central Florida that talk about guarantee, and never lose money. And when the market goes up, you get to participate. And isn't that great? And you know, doesn't that security really appeal? It's literally like the best of both worlds until you look at how it actually plays out. So we had a real life case recently in the office, and this individual had invested $300,000, which is a good chunk of money, into the particular product. What is fascinating, anytime anybody tells me the story, is nobody ever is told what the commission that pays on that is. So let me be very clear on that, just in case you're wondering, and you really should be. The commission that pays on that usually is around 6, 7, or 8%, okay, depending upon the bells and the whistles. So let's just pick the median number. Let's say it's 7%. So this guy invested $300,000 into this product. The commission that was paid was $21,000. And maybe that didn't all go to the guy that sold it or gal that sold it to him, but there was a payout from the insurance company to somebody that amounted to $21,000. Wouldn't you want to know that before you were investing? Do you think that might skew, putting aside the fact that, as we've pointed out in past shows, that a lot of these folks don't even have the licenses in order to be able to give you another investing option besides the one that they're hawking. Wouldn't it be interesting to know that, to know how much is actually getting paid in total on the investment of that money? Don't you think you might be kind of curious about that? Nobody's ever come into my office and been able to answer that question when I ask them that question. When they have a product like this, you know how much that guy got paid or gal got paid? Oh, I don't know. They said I wouldn't have to worry about that. I'm like, yeah, you should. And one of the most important questions to ask, as we talk about even in our ads that we run, is make sure you understand what the underlying transaction is on the business you're about to do. Because what happens is, if the insurance company is paying that big of a commission, guess what? They aren't doing that out of the goodness of their heart. And the way they lock that money up to make sure that they're going to be covered in case you decide to do something differently with that money is by putting a massive surrender charge on the product, should you decide to do something different. In this case, again, it was a $300,000 investment. Surrender charge $25,000 if you wanted to do something differently with your money. Got a little problem with that, okay, especially when I am older, and unexpected things can happen when I'm older, right? Particularly on the health side of the equation. So I might need access to a lot of that money, but yet I can't get it. Otherwise, there's a $25,000 surrender charge on it. We've got a bigger punchline on how it actually works, but we'll save that one for after the break. So stay tuned on that piece here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA.
WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on 102.5 WFLA. And also co-broadcasting on 540 AM. So we got to say hello to our AM listeners as well. My name is Joel Garris. I'm with Nelson Financial Planning during the week. Of course, today is Sunday, so that means I'm sitting here in the iHeartRadio station talking about a wide range of topics. So far on the program, we've tackled some kitty tax stuff, right? We've tackled the improvement in millennials opening accounts, but sadly, they're opening accounts and investing in some pretty aggressive, crazy stuff like Bitcoin and cryptocurrencies and cannabis and marijuana and all that stuff. And then we're doing a follow-up on a conversation we had with an individual that sort of extends the conversation we've had in prior radio programs of some of this garbage stuff that is out there from an investment perspective, and specifically it's the stuff that guarantees that you can never lose money and you get to participate in the market, and isn't that great? And what they never tell you, as we were talking about before the break, is how much actually gets paid. It's usually about 6 or 7 or maybe 8% of the amount you invest. Seems to me if you're investing in this particular case that we saw, it was $300,000. If you're investing in someone's going to get paid around $20,000 $1,000, might want to know that going in. Just throwing it out there. And of course, anytime I ask that question, they answer back, well, they said it wasn't going to cost me anything. Well, guess what? If someone's paying it for you on your behalf, it ultimately does, in fact, cost you. That's why there's a massive surrender charge should you decide to do something differently. So you kind of wind up being stuck in it for the rest of your life or a very long period of time. What's even more disturbing is when you actually look at what you get for underlying performance. So in this particular case, right, 2017, obviously a pretty good year for the markets. Indexes were up anywhere from 20 to 22% for the year. So you would say, my goodness, man, I'm going to clean up on this thing. Sadly, though, because of the way they make the calculations, the way they point it, the way they average it, the way that they cap it, look, that big, thick prospectus document that hopefully at some point you should have gotten because you're supposed to get it, is not written on just a couple of pages. It's written usually over about 50 or 100 pages, and the reason for that is there's a whole lot of mathematical tricks that are going on in there in terms of trying to calculate that number. So think of last year, really good year for the market, and what trickled down to this particular contract, the way that it was invested or set up, was 2.5%. Nowhere, 1/10 of the participation, and 1/10. Okay, so and the reason, of course, is that it can't really work that way, right? It can't be guaranteed to never go down, but yet participate in the market. It can't work that way. There has to be something more going on. And that's buried in the 100 pages of fine print that came with the contract that nobody ever reads. And even if you were to sit down and read it, it still wouldn't make sense because it's written by a bunch of lawyers using language that only lawyers can appreciate. And half the time, I don't even think the lawyers appreciate it. Anyway, so there's some real results on this garbage. Whatever you do, stay clear of that. Look, let me be perfectly candid with you. If you're concerned and you're nervous and you've got money that you just don't want to invest, just keep it in a dang savings account or CD or money market. Just keep it there. I understand the rate's low. But at the end of the day, do you really want to jam it into something where you're not going to be able to get access to it without it costing you a massive charge? Interest rates will go up. They'll trickle up a little bit. You'll start to make a little bit more money on that. Just be patient. If you really can't stomach anything with any volatility, folks, that's not the answer, is to run into something like that, because then you're locked into it. Period. Anyway, we'll step off the soapbox and shift gears to Social Security. Nobody ever gets on a soapbox for Social Security and Medicare, right? Yeah. Anyway, changes for the year 2018. There are, in fact, a number of them. And so we're going to try and hit the highlights on some of the big ones. First of all, full retirement age is changing, if you didn't know that. So full retirement age, okay, if you are born after 1954, then full retirement age is now 66. Okay, so if you were born in 1956, you're going to turn 62 this year. Technically, your full retirement age is actually 66 and 4 months. Why is that important? It's important because if you take Social Security early at age 62, the amount of that reduction that you get is based upon the number of months until your full retirement age. So if you're turning 62 this year, your full retirement age is actually not just 66, it's actually 66 and 4 months. Now, you can still claim Social Security at age 62, and sometimes that makes sense, particularly if you're not working. And there's some other factors that obviously go into that. In some cases, it makes sense to wait and take it at 70. But if you're taking it at 62, know that instead of those benefits being reduced by 25%, which would occur if your full retirement age was 66, now because your full retirement age is 66 and 4 months, for those of you who are turning age 62 this year, the reduction is actually closer to 27%, because how that early payout of Social Security works is it's based upon the number of months until you get to your full retirement age. If your full retirement age is going up, then guess what? So too is the number of months that you have to go to get to your full retirement age. And when you take those numbers of months, what you do is you multiply them by 0.05%. I don't make up these numbers or rules. Those are made up by our good folks in federal government. I don't know where they came up with 0.05%, but that's the number. So you take that number, you multiply it by the number of months until your full retirement, and then that determines the percentage of decrease that is going to apply in your Social Security. So just know that factor is getting higher as the full retirement age continues to push out. So an important change, well, not really a change, but one of the updates, I guess, that occurs naturally with each passing year is that full retirement age right now is sort of in the middle of making that shift from where it was at 66 to it's gradually shifting out to age 67 over the next few years in terms of calculating people's full retirement age. Other things, a lot of other things that are getting adjusted as they do each and every year. So we've got some other numbers to kind of toss out at you and for you to keep in mind on the Social Security and Medicare side of things. We will come back to that after this break here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 102.5 WFLA.
This This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. On the program, in this segment, we're talking a little bit about some of the changes, or I guess more along the lines of updates to Social Security, things that happen sort of every year and ultimately wind up adjusting the numbers on Social Security. Things like retirement age, which we talked a little bit about before the break, but also the earnings limit, for example, that you can make and still collect Social Security. For 2018, that also increased up to just over $17,040. So if you're collecting Social Security and under your full retirement age, there is, of course, a limit that you can make before you have to start paying back that Social Security. And that limit, in fact, increased for 2018 up to $17,040. There's a special number that applies when you are in your year of your full retirement age. So if you're turning age 66 in 2018, you can actually earn a much higher amount, $45,360 in the months leading up to your birthday without having to lose any of those benefits, or you don't really lose them. You just have to repay them when it comes time to kind of finalize up the numbers. So but at the end of the day, you certainly don't want to have to repay them. So anyway, those numbers have gone up. 17,040, and then if it's the year in which you turn your full retirement age, which would be turning 66 in 2018, that number increased to $45,360. Unfortunately, there were no changes on the amount of your Social Security that is included as income. The calculation for that has not changed in many, many moons. And so consequently, more and more people are seeing themselves get tripped up by the thresholds that trigger the taxation of your Social Security. So if you're making an individual that has other income of between $25,000 and $34,000, then you wind up going over the limits and starting to trigger taxation on your Social Security. That income basically looks at all your other income plus like half of the Social Security that you're getting to then ultimately determine whether you're above or below those thresholds. So depending upon where you are, maybe only a portion of your Social Security is taxable. If you're above the higher end of those thresholds, then the maximum 85% of your Social Security is included in income. So just know that there was, unfortunately, no changes on that. Of course, you did wind up getting a little bit of a COLA this year, a 2% increase. So a 2% increase in your Social Security benefit is the biggest COLA in 6 years. So yeehaw, right? 2%. Boy, you're going to be able to kind of see that. Probably not. It winds up being a $27 raise to the average retirement benefit that Social Security pays out. So, $27 was the cost of living adjustment. The biggest one in 6 years, though, but unfortunately, it only translates to $27 per month, assuming the average retirement benefit from Social Security. Bad news is don't start spending that extra $27 too soon, because what, of course, also happened is that the premium for Medicare Part B also went up. And so the average Social Security COLA basically gets consumed by the increase in premium for Medicare Part B. because most of Medicare Part B wound up going up to $134 a month, which is a $25 per month increase from last year. So remember that $27 raise? You just lost $25 of it. So that's a net effect of, $2 because the Medicare Part B premium also went up. And remember, one of the reasons why that Medicare premium kind of went up just proportionally so, right? I mean, it went up $25 on what previously was $109. So if that goes up $25 on $109, I mean, that's a 23% increase in your Medicare Part B premium. And the reason it's so big is because they're not allowed to increase Medicare Part B more than what the cost of living adjustment it gives you, okay? Because if they were to increase it at kind of the rate that they should be increasing it at, then you would in fact see your Social Security check going down. And that they specifically, there's a specific law that avoids that prevents that from happening. But unfortunately, that doesn't mean that when you get any level of COLA, that the increase in Medicare can't go and take nearly all of it. And in fact, that's exactly what happened. So you had a 2% increase in Social Security, excuse me, but a 23% increase in your Medicare Part B premium. So net effect is you wind up not getting anything. So I hope you didn't spend too much time celebrating the largest COLA increase in Social Security in 6 years, because it just got consumed by the amount of the increase in your Medicare Part B. Other things that are changing, the top amount of wages goes up a little bit every year in terms of the wage limit that you have to pay Social Security taxes on. That went up by another $1,200 for 2018, which means that the first $128,400 of wages paid in 2018 is in fact subject to Social Security tax. All income is subject to the payroll tax that funds Medicare, and in addition, higher income earners, individuals over $200,000, married couples over $250,000, still have to pay a surcharge of an additional 0.9% on that Medicare piece. So no changes there, except for the increase in the amount of wages that you do have to pay Social Security tax on as well. Also, and we've talked about this in a prior program, the surcharge, the Medicare surcharge, where you have to pay more for your Medicare because your income is higher, that also shifted dramatically for this year based upon 2016's returns, but also based upon a change in the numbers of the income thresholds that trigger when you have to pay an additional surcharge on your Medicare. So that we've certainly talked about on a prior program, but that also was a big change for the year 2018. And then, of course, to get a credit with Social Security, you have to earn at least $5,280 in 2018 in order to get the maximum 4 credits versus only $5,200 in 2017. So those are the highlights on Social Security and Medicare. Some of the changes, not really new changes, more like just changes that happen every year. But that's the latest and greatest update on those numbers. So hopefully that was an informative part of the program. And if you want to listen to it again, of course, we'll have it posted on social media and our website starting tomorrow. Thanks for listening. Thanks for being a part of the program. This is Joel Garris, Nelson Financial Planning. You'll be listening to Dollars and Cents on News Radio 102.5 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 1025 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.